Morning and welcome to our today's Coffee and Consulting with the topic tax challenges due to hybrid cross-border working models. We have a nice topic which I think lots of you have deal with it most likely on a daily basis even, and we will look at mainly what are the tax implications as well as what are the obligations in the end also for the employer. My name is Friederike Ruch and I am today your host. Before we start, everybody of you is unmute, so in case you do have any questions to that topic, either for clarification or in addition to it, then just drop a note and your question in the chat box or in the question box, and we will get back to you after the coffee and consulting. Also, in case you would like to download the slides, please do so. You're free to do that while we have the event. And in addition, the coffee and consulting will be recorded, and you also can then later on check that out or listen to it again in our YouTube channel. Then let's start, I would say. There are not that many slides today. However, the topic is quite or has a lot of different aspects to look at. And before we start then really with going into detail about the tax bit as well as then the obligations from the employer, we all, I think, should be going at see to that we are on the same page. So if we talk about hybrid work models, then this is either employees being completely flexible in how many days or hours or periods they are working in the office. Usually also you have people who just will be there to the core office hours or working on a shift arrangement. So whatever work model you have, this is now thinking about it. How can that be now hybrid? And hybrid means also not just working in the office itself, but maybe also from home or in different locations. And if we now talk today about the cross-border aspect, then we look at the topic that the employer is in country A, as you see here also on that slide, and the employee is either living or just working for a part of the time in country B. And if you now think about your employees in your firm, then I'm sure you have already, there are a couple of people coming into your mind who will be working on a hybrid work model where there is a border in between. And if you think about situations like cross-border employees who, for example, live in Germany, work employed here in Switzerland, and they work either remotely a couple of days or whatever number of days or hours from home in their home office, or you have people who have dual responsibilities, meaning they might have are employed here in Switzerland, but might have, in addition to their responsibility for the firm here in Switzerland, they have a responsibility for a firm also or for an affiliated legal entity somewhere in another country. And they have then to be there also from time to time. Also thinking about that people who might be just assigned for a short term of period and then coming back. So and that needs to be on a regular basis, not just as an assignment as such, but maybe during the year they have to be there for a certain number of days per year. Workation is also something where you have maybe someone who is working in a different location and has, for example, put down the request that he can work for a couple of days a month in a different location, like for example where his or the employee's parents are living, and he wants to spend a bit more time for that. Or the employee has a work has somewhere a vacation home, he wants to be there more often. So there are lots of different situations. The remote working or the working in the other country, and other country is meaning not the country in which the employer is situated, can be completely different and is not really fixed. What we see based on that flexibility firms are giving to their employees, that due to that in the end the tax situation, immigration, social security, so all the legal aspects are sometimes a bit hard to assess, as flexibility will be put in really in the center, and then it's not that easy to define everything always in the best way. But if we look at the tax part and then think about the first scenario. The first scenario is our employee, let's call him Mr. Miller. Mr. Miller is employed in Switzerland. He is now working in, for example, in his home, where his residence is. Let's say it is in France. He might be fully remote working, or maybe coming a couple of days per month or per week into the office. If we say he's fully remote working, we understood that from a social security point of view, he will be subject to social security contributions in the residence country. So in our example, that is now France. Country B is France. And let's say the employer has an affiliated legal entity as well. And the affiliated legal entity will actually run the whole payroll for him, like taking care that social security contributions will be dealt with, and the employer A will be charged for that, because in the end everything the result from his work will be for the employer who is still situated in country A. The payment, and there are a couple of scenarios where we see that the affiliated legal entity is also making the payment because it's much easier. Everything can be done through that legal entity, so there is no double payrolling required. Therefore, everything will be done through the legal entity, which is also situated in our example in France. The charging, however, because as said, the result of whatever the employee is doing will be for the employer who is situated in country A. Now, if we look at the tax situation, then if the employee is working 100% in France, then he will be also subject to taxation of his employment income in France, which is, I think, the easiest case. Now, in case we have in that scenario, we have also that the employee has to spend maybe a couple or a few days in the end per year in Switzerland, where the employer is situated. What will happen now with Switzerland? Will there be any taxation on the work days he is spending in Switzerland? Yes, there will be. Because in our example, the costs are completely borne by the employer, so which is in country A, and therefore the couple of days he's spending in the end in Switzerland will be subject to taxation in Switzerland. Because in his scenario, we would look again at the 183 days rule. And if we look at the three conditions which are required, which is basically he needs to spend less than 183 days in Switzerland, no salary is paid out in Switzerland, which will be done because we said that the salary will be paid out through the affiliated legal entity. But the third part is that the costs being borne. And the costs are borne by the employer in country A, so in Switzerland. Therefore, the taxation will be for the few days in Switzerland. There will be tax at source to be deducted. And with that, or based on that, you will end up in kind of running a second payroll also in Switzerland. So there will be the payroll in France with paying out the salary and calculating the social security contributions, as well as the taxes on all non-Swiss workdays. And then there will be the shadow payroll in Switzerland for the couple of workdays in Switzerland for calculating the tax at source. Now, what also has to be done is, in the end, the tax at source, which had been calculated now in Switzerland, needs to be deducted from the payslip in for the employee in France as well. So before the next payout, then there needs to be then the deduction made so that the employee is in the end bearing the Swiss taxes. In that scenario, and assuming now that the French taxation is higher than the Swiss taxation, I think there will be no disagreement from the employee side in saying, oh, I don't want to have that deduction from my pay, because in the end, there will be then a credit for that towards the French taxation. In case now the taxation for the workdays in Switzerland would be higher than the tax which is deducted in the residence country, the employee might come back and say he wants to have an equalization for the higher taxes. So that is something you have to keep in mind. Usually what you would do in those scenarios in order to avoid that discussion, to basically say whatever employment income tax has to be paid, employee, it's your responsibility. There's no cross up, there's no tax equalization, nothing like that. That is differently than if you have situations where you send people to a different country to work for you on an assignment basis. Usually you have in those situations, you have the idea or the wish is coming from the employee in saying he wants to work from home. Now, there might be also scenarios where, as a firm, for example, you hire someone in the UK because he should be dealing with you for the UK market, should look like business development purposes or whatever, or you have only just found the specialist you were looking for in the UK, but the person doesn't want to move to Switzerland. then you need to think about what you would do in the tax part. Usually, what you do in the beginning when you determine then the gross pay, that you will kind of consider the possibilities of having having a couple of days being taxed in Switzerland, as well as the majority of the time being taxed in the UK. Basically, the country in which the employee has his residency is usually also, from a tax purpose, we would look at that as the tax residence. And in all those scenarios, is that the important assessment you need to do, or the important fact you need to look at, because wherever the employee has his tax residency, that means ultimately that he will be subject to his worldwide income in the country he has his tax residency. And if you then want to check out whether the other country in which he maybe is also working a couple of days, um, whether there might be some taxes, some taxation involved as well, you need to check on the double tax treaty. And the double tax treaty you need to look at is always with the tax residency country plus then the country in which he is working sporadically. In our example where we said the affiliated legal entity make the payout and plus there is one, we said taxation, social security is in France in our example, and only the couple of days he's working in Switzerland will be taxed in Switzerland. If we take now the second scenario here on that slide, which is the employee, now we say he is working in Germany, for example. There is no legal entity, no permanent establishment, nothing. So the employer has no kind of vehicle or no sponsor where he can employ the employee. From a Swiss perspective, that is not really an issue. You can employ someone in another country who is working for you directly, where whatever kind of work results there are, which are then belonging to the employer. Now, if we take the example again, the employer is situated in Switzerland, employee has his residency in Germany and is now working full-time in Germany. Is there any difference if we compare it to the example we just discussed with France? No, there's no difference at all. It works actually in the similar way. The only difference is now that there is no legal entity, and therefore the obligations for the employer is just about the social security part. In our scenario now, the employer, so the Swiss firm, has that employee working for him in Germany. And if we say the employee is working 100% in Germany, then we know if we make the assessment, we come to the conclusion that Germany is the country in which he is subject to social security contributions. So based on that, you would need to have someone who actually will make the declarations to the social security authorities, who actually can calculate the contributions, which are different than the Swiss ones, for the employee. If we do that ourselves here in Switzerland, there is the possibility. However, I think you should be quite careful with that, unless you are the expert from a German perspective. Otherwise, I would recommend you to actually hire someone in Germany, like a tax consultant or a payroll service company, who is doing and running you the payroll for the employee, as well as then making sure that the contributions will be paid to the Social Security Authority where it goes to. In Switzerland, basically, as long as the individual is not working in Switzerland, there's also no need for running a payroll in Switzerland. So basically, just in Germany, there is a need to run the payroll. The only thing which the employer now doesn't need to take care of is the tax part. Because there is no legal entity in Germany, there is no need to deduct anything from the employee. The situation is rather than the employee actually has to contact the tax authorities and say, I don't have any employer in Germany. Please provide me with some on-account pay slips so I can pay the taxes. And he has then to file a tax return in the end, and based on the filed tax return, the taxes will be assessed. So it's different than where I do have an affiliated legal entity where I have to do something. The end result, however, is the same. Also, the employee in the first example with France, he will have to file a tax return and the final tax liability will be assessed based on the filed tax return. So basically, that's the key difference between those two examples. Now, what kind of employer obligations do I have? So I need to check basically about the withholding tax requirement, meaning whether I'm responsible for deducting the taxes, like in those two scenarios where we looked at just a second ago. There you can see the difference. Now, that does not necessarily mean that whenever you don't have a legal entity or a permanent establishment you can kind of use as a sponsor, that means there is no withholding tax requirement. That can be completely different. So this really has to be checked country by country and situation by situation. Also for that, it makes it useful or is quite recommended to use someone in the country who can actually support you and can help you with that. Social Security, definitely that's an obligation. As an employer, I have to make sure the employee is covered in the right country, as well as that the coverage itself is to what I actually have also indicated in the employment contract. And that actually leads to the part that if, for example, I use in my example with France a Swiss employment contract and he is fully subject to French social security contributions, then clearly if it goes if it's about the child allowance, for example, which is in Switzerland going through the social security, or whether it's about the continuation in case of long-term sickness or long-term accident, then it's not any longer the rules from the Swiss rules. So the Swiss rules coming from the accident insurance or the daily sickness insurance. It's then whatever the rule is for continuation of salary payments in case someone is for a longer term sick or had an accident and is therefore not able to work. That is going based on French rules. And I have to make sure in the end, in the employment contract, that I not say, oh, employee, you are now, you will be fully covered in the Swiss system, meaning in case you will be longer term sick, you get actually for those 2 years, you get the salary being paid by 80% based on the daily sickness insurance I have. If he is covered in the French system, then it's not any longer those 2 years, it's then whatever the French system will say. So that is definitely something you have to look at, and it's an obligation as an employer also to make sure the employee is aware of that he's not thinking about, oh, I'm good for in case I am longer term sick, I have those 2 years. Better to that he is also aware of the real situation and his real coverage. Mandatory requirements, labor law. In our example with France, clearly where he's working most of the time out of France, there is French labor law being involved as well. Now, each case has to be looked at separately to see whether it's really the full French labor law has to be implemented or maybe just the mandatory requirements. And therefore, it's quite useful to actually have a French labor lawyer looking at the contract as well. Immigration, it's still the obligation from the employer to make sure the employee has the right work permit or the right notification has been done in the country he is residing, as well as in the country the employer is situated. If we look at the payroll part, we've seen the situation that there is the need then most likely for two payrolls, meaning for the payrolling in the country of residence, as well as in the country where the employer is situated, as long as he is then also working in that country. So there's a lot of different things to be done, and therefore it's really worthwhile to get someone involved who has the overview of everything, as well as has the knowledge and the know-how to actually help you with that. Or you have someone very well trained in your payroll team or HR team who is aware of the different scenarios and then just picks an expert for the one or the other topic to get the feedback there. To sum up what we just discussed, here a quick example. We have a Swiss company, the Wisdom AG in Basel. They have an employee who is residing in Hamburg in Germany. He's married, has 2 children, is French national. His function is IT manager, and he works 2 days per month in Basel, and otherwise he works from home. So basically he works 60% from home in Germany, and 40% he works, no, not true, 2 days per month only, so even less than that in Switzerland. Based on those facts, I think if we look at what is the country he has his tax residency, then we most likely come to the conclusion that will be Germany. If we look at the country in where he has to pay social security contributions, I'm sure we come back to the conclusion that it's in Germany and not in Switzerland because he's working most of the time from home in Germany. So let's see what then the result of it is. If we look at the payrolling, clearly we do have to have a payroll in Germany. Now, if we say there is no legal entity, so basically we go and get an tax expert helping us with the payroll in Germany, just for calculating the German social security contributions. So we have the shadow payroll in Germany. As we do want to make the payment from the Swiss firm, we doesn't want to have that done through anybody else. So we make the payment here in Switzerland. Therefore, the payroll is here. And what we have to do is, from a deduction point of view, we have to deduct from the cross pay the German Social Security contributions, as well as then the taxators for the days he's spending in Switzerland. For that, he has to fill out a calendar, so we know exactly how many days he had been spending in Switzerland. In Germany, he will actually have to get taxed on any non-Swiss working days. Everything else, so in case he would be maybe go on a business trip to Italy for a few days, those days will be taxed in Germany because that is his tax residency. Work permit wise, now he is French national. He under the EU agreement, he is able to get a residence permit in Germany based on his nationality. So there's no problem at all with that. Now for Switzerland, because he's working there as well, there is the need then for a work permit as well. So either it's a 120 days permit or maybe a cross-border permit. This needs to be checked with the immigration authority to see what are the possibilities. Also, there is the possibility to get the notification for the employee. Now, just to notify always every month those 2 days, that might be a bit too much administration, and therefore maybe you rather choose something where you don't have to do every month something. If we look at labor law, clearly because he's only working 2 days a month in Basel, and if we say he had never worked before in Switzerland, so there might be the high likelihood that just German labor law might be applying for the situation. However, that definitely has to be looked in more detail. Home office expense is something which will be ruled then according to German rule, and there are some specific things you will have to do as an employer, and that is also something. If the employer is situated in Switzerland, that doesn't matter really. You have to consider that as well when you employ him. What might be a bit tricky is if we look at the Social Security part, where we said he will be fully subject to German Social Security, that because he's working also 2 days a month in Switzerland, we would need to have an A1 form from the German Social Security Authority being stamped and signed, so that in case there is an audit in Switzerland, we can have the proof that the individual had been subject to German Social Security contributions and not Swiss ones. And that is basically everything we need to do. So it looks a lot, and it's sometimes not that easy because not everything is really working the same way as the other. However, if you have once set it up, then there's actually really no problem at all in running that properly. I'm sure you have those scenarios as well in your firm, so in case you need some support, then just let us know, or and we can most likely then guide you as well to the right person. Again, as said, if you have any questions, then just let us know, and we are happily to get back to you with an answer. Before I will close today's Coffee and Consulting, I would like to take the opportunity to show you what we do as next. One of the next things will be next week already our half day seminar at the Hotel Bauer Luck about the insurance coverage and the right application of the Social Security part. There are still a few places left, so in case you are interested, then just book your place. And then in November, we have about management transfer in Switzerland, which is also quite a topic. Then our next webinar is on the 28th of October about expat payroll. And our next coffee on consulting is at the 6th of October about outsourcing payroll and global mobility matters. I hope you enjoyed today's coffee and consulting, and we hope that we can see you soon at one of our next events. Thank you very much for your attention, and have a wonderful day.